Good evening and welcome to CEOs Get Real. I'm your host, Christopher Marston, and today's guest, we have Howard Crosby, the CEO of Nevada Comstock. Howard, welcome to the show.
Chris, good to be here. Great to be on your show. And as I said just a minute ago, we're doing this and we're properly socially distancing from one another.
That's right. I wish you were right next to me drinking. What do you got today?
Yeah, I've got a gin and tonic. I ran out of Irish whiskey over the weekend, so here we are. But we'll make it work.
I love it. Well, I got an 1998 cab right here, so I'm ready for you.
Okay.
Well, Howard,
Wonderful.
where are you calling in from today?
I'm actually in Spokane, Washington at the moment. I spend most of my year I spend down in Palm Desert, California, near you. But it's good to get out of there when it's 115 in the summer. So I came up to Spokane for a few months.
Yeah, it's better. It's getting hot up here too. So I've been doing more gardening with this COVID stuff than ever in my life. So I've had to water the plants every single day.
There you go.
Oh, love it. Well, Howard, tell us a little bit about your background. You've got Nevada Comstock in the gold mining space, and you have
we actually have my partner and I formed this company a few months back and started working obviously with Exemplar Capital. But we have a long history of being involved with successful mining projects over the last 30 years. And we've put together a very experienced team of technical people, as well as management people with over 100 years experience. And with Nevada Comstock, what we've done is we focused on properties on patented mining claims, which we think is an incredibly important differentiation factor. All three of our properties have past production history. All three of them have significant opportunity to expand and restart operations. And we focus primarily on precious metals, gold and silver, but we have substantial copper and base metal byproducts as well. So we're very excited about the projects that we have, and we're very excited about working with Exemplar.
Well, thanks, Howard. We've enjoyed working with you guys. You're smart, and you guys you've got it together. You have a good history. It's a mature management team, and we've been really enjoying that. Maybe you could share a little bit with our audience a bit about your history, because you aren't new to this field by any means, and it's real important to share.
No, I've been working I actually graduated from college back in the mid-'70s with a bachelor's degree in history, but I got plunged right into the mining industry not long out of school, working for United Nuclear in the uranium business back in the late '70s and early '80s, and moved on from there and met my current partner and associate, John Ryan, in the early '90s. And we've been involved in a wide variety of mining projects. And just to catch up to the new century, in 2002, we bought the Mesquite mine from Newmont Mining Company, one of the largest gold mining companies. They had shut the mine down. It was on care and maintenance. And we raised about $15 million and bought them out and continued leaching the existing gold from the existing pads. And ultimately, we were a little early in the gold market in 2002. It was just emerging from a deep slumber. But we ended up successfully selling off the project to some Barrick executives who have now, they turned it into a 175,000 ounce a year producer, became a company called New Gold, which was then recently sold to Equinox. And it's continuing to operate down in Imperial County, California. And then in 2004, we were involved in a project called High Plains Uranium. We took the company public on the Toronto Stock Exchange, and we were bought out less than 2 years later for a 5x win for our investors in the public round. And then in 2006, we bought the Galena mine, second largest primary silver mine in U.S. history, from Coeur d'Alene Mines. They were about to shut it down. We bought it from them for $15 million. We raised about $65 million on the Toronto Stock Exchange. We took it back into operation, and it's still producing today. We sold our interest off to a company called America Silver about 6 or 7 years ago, but it's still producing at a rate of about 2.5 million ounces a year. So very significant primary silver mine. And then more recently, I've been involved as an executive chairman of an operating gold mine in western Utah, which is currently producing about 1,000 ounces of gold a month from an open pit heap leach gold mine.
Wow.
So lots of experience, lots of different projects, and we think the timing now for investors looking to diversify into precious metals could not be more propitious.
Yeah. Howard, tell me about your partner. Your partner's been in this space a while too, right?
Yeah, John's about 10 years younger than I am. He's a mining engineer by degree, and he also got a law degree from Boston College after he got out of the Navy. And we've been working together pretty much exclusively for the last 26 years.
Wow.
So, yeah, he's a real smart guy and a real talented engineer as well as businessman. So we've been a great combination to be able to play off each other down through the years. And obviously, we became convinced over the last year that we wanted to focus on patented mining claims. And what that means to your viewers that may not understand the difference, we're operating all of these projects on private land. These properties were what was called patented under the 1872 mining law at some point in the past, meaning that the federal government granted permanent title to the surface and minerals in perpetuity to the owner of the property. So a patented mining claim is basically the best title to any property you can have because you own everything from the center of the earth to the top of the sky. And for the purposes of what we're trying to do moving forward with the company is it's much, much easier to pursue getting your permits and getting into operation when you're on private ground.
Mm-hmm.
You're really only dealing with the state agencies rather than the federal government.
Right.
So you're not having to deal with the Bureau of Land Management or the Forest Service. Now, you still, of course, we must comply with the health and safety requirements of the Mine Safety and Health Administration, which is the mining version of OSHA. And we have to make sure that we're complying with the Clean Air Act and the Clean Water Act at the federal level. But that's really the only interaction we have to have with the feds when we're operating on patented mining claims. And so we're in a much better position to move forward with these projects, to deal with any issues that we have to deal with at the state level. In the case of the Lexington project with the state of Montana, at the Ajax with the state of Idaho, and with the Gray Eagle project with the state of California.
Howard, tell me about the case for mining. When you and your partner got together on patented mining claims, what was the case for gold at the time? Because it's obviously changed since COVID hit.
Yeah, it's only gotten better for us, but
right.
It was already getting real good by the fall of last year because, we've seen an explosion of debt, an explosion of printed money in this country in this century. If you go back to the beginning of the century with the beginning of the George W. Bush administration, at that time we had a national debt of just under $4 trillion. By the time he left office 8 years later, it had gone to almost $9 trillion. The Obama administration took office in 2009, January, and by the time they left office, it had doubled again to 18 trillion. And then before COVID hit us in March, we'd already accumulated another 5 trillion in just the last 3.5 years. So the explosion of federal debt, which has pretty much mostly been entirely monetized by the Federal Reserve, is, in our view, leading to the rapid deterioration of the value of the currency.
Right. So for those of us, you and I share something in common around our love for economics. So it's going to be obvious to us the connection between printing a limitless amount of money and perhaps the case for gold. Could you make the case for those who aren't studying the connection? Yeah.
Absolutely. Let me start by saying that people throughout my career have always asked me, Howard, what do you think of the price of gold? And I say, well, gold doesn't have a price. Gold is money. It has an exchange rate. You wouldn't ask what's the price of a yen or what's the price of a euro. You'd ask what's the exchange rate.
Right.
So the Federal Reserve was created back in 1913 in the Wilson administration with the specific mission of protecting the value of the dollar. Now, during that time, the dollar has lost somewhere between 96 and 97% of its purchasing power. So you've got about 3.5 cents worth of value left from the 1913 dollar. And yet in 1913, an ounce of gold was worth $20.67 an ounce. It was revalued in 1934 by President Roosevelt when he devalued the dollar and struck the gold price to $35 an ounce. Today it closed at $1,285 an ounce on the spot market. So it's safe to say that for someone that held an ounce of gold in 1913, that ounce of gold has preserved its purchasing power across 107 years, while the US dollar and all other fiat currencies have lost somewhere around 97% of their value.
Right.
In other words, if someone had stuck a $100 bill or $1,000 bill in a safe back in 1913 for their great grandchildren, today it would buy about 3 cents worth of goods.
Right.
But that ounce of gold would still buy the same sort of goods and services it would have bought back in 1913. So gold is the only money that is not someone else's liability. The US dollar is a liability of the US government. The Japanese yen is a liability of the Japanese government. Or as the longtime prognosticator of gold, Doug Casey, says, the US dollar is an IOU nothing, and the euro is an IOU nothing by nobody.
That's funny. Howard, that's great. So tell me about patented and compare the other types of mining operations for gold versus patented claims. Obviously, there's a procedural process that makes it easier. What are the other benefits?
I mean, obviously, the big benefit is your regulatory regime is far less. So let me just talk about if you stake claims, which you can do under the 1872 mining law, you can stake unpatented mining claims on federal land. So if you go out and stake claims, you pay an annual fee of $200 some per claim per 20-acre claim to hold the claim. You pay that to the BLM or the Forest Service, and then anytime you want to do anything on that claim, you have to apply to the government, the Forest Service or the Bureau of Land Management for a permit. Just to undertake a drilling program, you have to file a permit application. In some cases, these permit applications are backlogged more than a year or more just to get a permit for drilling. And then when it comes time to actually move forward with the producing operation, you have to go through many times years and years of public hearings, environmental impact statements, public comment periods, lawsuits from possibly groups that are opposed to what you're trying to do. Most of these hurdles are alleviated when you're operating on patented claims. You're really only dealing at the state level. And for instance, in California, where the Gray Eagle mine is, most of the decisions are made by commissioners at the county level. And under the state law, there's what they call grandfather provisions, where if there's been an existing mine there, a lot of the things that you would have to do are grandfathered in because it's already a disturbed site.
Right. Right. So tell me about, from a patented mining claims, those don't know the definition of it other than its nature that it's on private land. Does that mean there was gold there? What was done to assure that there's resources?
At the time the 1872 mining law was passed until about the late 80s or early 90s, if you could establish that there were valuable minerals on your claim, you could apply for a patent. And the government, the U.S. Geological Survey and the government geologists would evaluate your claim. And if they agreed or validated the fact that there were valuable minerals on that claim, you would be issued a patent, which would be signed by the President of the United States, granting you title to that ground in perpetuity. And then it was no longer federal land, it was your land. Under the 1872 mining law, theoretically, that would still be possible, but they suspended granting any patented claims back in the late 80s. Mm-hmm. And there have been no patented claims granted over the last 30-some years. And there never will be again.
Interesting. So how do you get a hold of them?
Well, you acquire them by purchase or lease from the owner.
Okay.
The same way you buy fee simple real estate on your house.
So those claims have been sort of hanging around like people's old bonds, right? Old bearer bonds, and somebody. So were they waiting for the price of gold to go up, or what was the wait for people that have not monetized their patented gold claims?
Well, I mean, in many cases, patented claims have been handed down from family member to family member through estates, and you get third or fourth generation great grandchildren that own these claims, don't know anything about them or what to do with them. They're happy to get money for them. In the case of a couple of our properties, we leased them from small mining companies that acquired them a long time ago, and we have lease purchase agreements where we are making a small monthly payment on them. And all that applies to an ultimate purchase price once we've established that we want to go into production with them. So
Right.
every case is going to be different, Chris, in terms of how that claim is held, but by whom. But most cases, these claims have been held for maybe more than a century by someone.
Right. So in the case of a generation, I mean, the case of mining companies, obviously there's the element of the Wild West. Everybody's sort of out trying to make it happen. When you end up getting it from a mining company or an older one, have they run out of resources to mine for it, or what are the situations that would lead them to give it to you?
Let's talk about the Gray Eagle. That's a good case. The Gray Eagle is what's called a volcanogenic massive sulfide deposit up in Siskiyou County, California. It's a very interesting property.
Yes.
And, it was developed back in the 30s, and in the early part of World War II, Newmont Mining Company mined it and produced about 480,000 tons of high-grade copper from an underground mine at the Gray Eagle. And when the war was over, they abandoned the property, turned it back to the underlying owner, and went on about their business once they could get back into gold. And then in the 1980s, the owner, Syscon Corporation, leased the property to Noranda Mining Company, a big Canadian major. And they came in and they produced over the course of 4 years 180,000 ounces of gold from an oxide zone. They built an oxide processing mill using solvent extraction, vat leaching, and they produced gold and made a great deal of money from a high-grade oxide open pit zone. And they were carrying on with that for about 4 years. And then in 1988, the underlying owner got into a dispute with Newmont, or with Noranda rather, and they pulled their lease. So Noranda was off the property. And then shortly thereafter, in 1990, Syscon filed for bankruptcy. Not having anything to do with the Gray Eagle, but they got into trouble on a drift mine down in Placer County, California, and they ended up in bankruptcy court. But before they did that, they hired a very well-known mining engineering firm to do a complete economic analysis on the property. The firm was called Pidcock, Allen and Holt. They've subsequently been bought out by another engineering firm. But they did a full 75-page analysis on the Gray Eagle, and they came up with a resource of some 15 million tons containing approximately 0.75% copper and a bit of gold in the underground resource. And there's also a remaining oxide gold resource, which was a very high-grade open pit resource that we need to reevaluate now as perhaps one of our first targets, because it's at surface, it's oxidized, and it runs very good grade in gold. So we need to determine how many surface oxide ounces of gold there are in addition to this very large underground copper gold resource.
So Howard, has technology changed over the years that allows you to monetize this? Is that a part of the story here?
Yeah, for sure there are technological advances that have occurred, especially since Newmont was mining at the Gray Eagle, for instance, in the 1940s. There's a lot of technological advances. Certainly, when Noranda was there in the 80s, they used solvent extraction leaching technology to recover the gold. And what we would do would be relatively similar to that. Where we would have real advantages is when we go underground after the large copper gold resource. There's much better mechanized equipment now that would allow that operation to be more of a bulk mining operation than it was back when Newmont ran it in the 40s.
Right. Okay, that's so interesting. Didn't you say something about volcanic, the nature of the land?
Yeah,
Yeah.
it's called a VMS deposit. The Gray Eagle is. It's a volcanogenic massive sulfide. And what's interesting about that, Chris, is that back in the day, such as when Newmont was there, when the property was discovered, the geologists had not really didn't really understood the nature of VMS deposits, and they tend to occur in clusters, which is why we're very excited that there could be other undiscovered extensions of this rich copper gold ore body very nearby, because almost never do these VMS deposits occur uh, as a one-off. They're more like pearls on a string. You know what I mean? Typically, if there's one, there's going to be others around the area.
Right.
That's the nature of these VMS deposits.
How did you get to know about VMS deposits? How did you learn about it?
Well, it's been well established in the literature over the last 30 years, and of course, John's much more familiar with them than I am. He's a mining engineer, and I'm a mining executive. But I've been around this enough to understand enough to be somewhat dangerous when it comes to geologic standing.
That's great. Well, when you go and you embark on the venture with this raise, what is it, $5 million initially? First
Yeah,
time?
we're looking for a $5 million initial funding from with the help of your guys at Exemplar, and that'll go a long way for us. We didn't really discuss what we're doing up in Montana at the Lexington, but that's another very exciting project. And that was a high grade silver, lead, zinc, gold mine that was mined back in the 20s and 30s and into the 40s. And they mined very high grade veins for silver that had a gold credit and a base metal credit. And there are about 110,000 tons of mine dumps that were too low grade to be processed back in the 30s, but they've been extensively sampled and they contain a substantial amount of recoverable precious metals and base metals.
Huh.
So part of what our initial use of proceeds from the financing that we're doing is going to be to simply go in with a front end loader, pick those dumps up and ship them 50 miles away to a mill, process them and turn them into cash.
No kidding. So Howard, this is really important, right? So a lot of people think of this as, you can only drill, you only get so many shots, right? You're going to drill a bunch of holes, and if X marks the spot and it marked the wrong spot, you're kind of screwed. What you're telling me here is that you actually have now, with the technology and the properties, access to monetizable assets nearly right away.
That's correct. Now, at the Lexington, there's two, besides the dumps, which are going to provide us some money, and that's great and whatever. Yeah. But there's really, really big upside on this property. So there's a series of like seven veins that were mined in the past, and they all ran, better than 20 or 25 ounces of silver with maybe 7 or 8% combined lead, zinc, and a bit of gold, maybe a fifth of an ounce of gold. A 0.05 ounces per ton gold. So, in today's dollars, I mean, we're talking about ore that's running $400 a ton or better. And our estimated mining cost and processing cost per ton of ore mined from these high grade veins would be no more than $150 all in. Mining, transportation, processing. So, and we believe there's potential for very substantial extensions of these veins beyond where the old timers left off. And there's a very clear geologic reason why this is the case, which John can explain better than I can. But basically, there was a post-mineral bed that came in of non-mineralized material. And so when the old timers were sinking and they hit this bed of non-mineralized material, they just stopped because they had no way to determine how much of that there was or if the veins picked up later. But we now know for a fact that these were post-mineral dikes that came in. And underneath these post-mineral dikes, these veins continue at depth. We know that for sure.
Howard, can I interrupt you a second and have you just share the explanation of the concept of veins in mining?
Yeah. Well, a vein is typically where the mineralizing fluids have come up into a crack in the rock, and maybe there's a suitable silicified quartz matrix like a quartz vein that will be anywhere from, on the small end of something that's mineable, maybe 3 feet wide, to up to 10 or 12 feet wide. and that vein is actually very much like a vein of envision a long hallway in your house, and that
Right.
hallway is filled with silicified material that has base and precious metal mineralization contained within it.
Okay. So are veins largely vertical, meaning through the earth rather than horizontal?
Ideally, they're vertical. Yeah.
Okay.
Sometimes they get laid over at maybe a 45-degree angle, and that makes the mining more difficult
Okay.
because the muck doesn't run, as they say. But you hope for a nearly vertical vein because then gravity's working for you all the time.
Got it. Got it. So you were saying that a prior group gave up or stopped. So what happened? What happened since then that made you realize that this may continue?
Well, it's subsequent to that time that they were operating back in the 30s. You know, they didn't have the same kind of equipment for diamond drilling and testing that we have. And subsequent to that time, there was another tunnel driven in the district at a much lower elevation in the mountain that intersected one of these veins at depth. So we have all kinds of evidence that these veins continue below where the old time miners left off in the 30s.
How deep? Yep. How deep were they able to go in the 30s? By the way, do you know?
Well, they went in with adits. They didn't sink a shaft. They drove a tunnel in at different levels on the mountain.
I see. Got it.
And we would do the same thing. We would drive in a tunnel at a lower. Well, we'd start with the tunnels that are already there, and sink what's called the winds through the dike, and we drill test the veins from the existing tunnels that are already there and accessible. So we don't have. When you look at a property like this, Chris, it's important to realize that coming in now in 2020, we're going to benefit from workings that were developed years ago that would cost us, on a reasonable guesstimate, $20 million to replicate if we had to start from scratch. They're already there. They're open. We can walk in and start right there.
Yeah, that's really important, right? I mean, don't you have competitors that are really starting from the beginning on other properties?
Yeah, of course. And there's another target on the Lexington that was developed back in the 80s by a geologist for Molycorp up in what they call the Saddle. And he postulated that and he did a bunch of sampling up there, and he tried to sell Molycorp's management on a drilling program to test this thesis. But they were only interested in molybdenum at the time. They weren't much interested in gold. And he laid out a whole program on this, what they call the Saddle target. And he projected that there could be as much as 30 million tons containing as much as 4.5 million ounces of gold right near surface. And so that will be one of our earliest missions, to go back and test that thesis that geologist Glenn Zinn laid out for Molycorp back in the late 80s.
That's wild. Well, there's a saying, Howard, success leaves clues. So the chances are, if you're going into a place that already put that kind of resources into it, and they got a lot of profit out of it, that you're onto something relative to competitors who are drilling holes based on a hypothesis, right?
Well, the best place to find a mine is where there's already been a mine.
Right, that's what I mean. Right.
Yeah.
So Howard, tell me about the exit plan. I mean, is there a potential public market exit here, or where does this go from here?
Yeah, I think there's several different things we could do, but I think after we get through this round, we're going to have, with this $5 million that we're getting now, Chris, this is going to create a lot of value accretion to our company and our shareholders. And I think at that point, we're going to have some very substantial, what you would classify as 43101 compliant resources. I would expect we'll have what's called a preliminary economic analysis on both the Gray Eagle and the Lexington. Probably not on the Ajax out of this first round, but at that point, I think we should be in a position to do a very substantial public offering, maybe in the order of 25 million.
Yeah. That makes sense.
And in the meantime, we will have shipped those dumps and made some money doing it.
Yeah, it sounds like you'll have some abilities to monetize in the meantime, which is probably not as common as anyone else out there.
Yeah, in this business, very rare. You know, there's a lot of similarities, quite frankly, between precious metals exploration and development and biotechnology, because in in most cases, you go years and years and spending lots and lots of money with nothing coming in. While you go through phase 1 trials, phase 2 trials,
Right.
phase 3 clinical trials, 7, 8 years and tens of millions of dollars trying to get something approved for sale. But once you get there, you can have a huge return, right?
Yeah. That's right.
It works. Yeah. Mining's quite a bit the same way, particularly if you're starting with a what I would call a greenfield site, where from discovery to the time you actually pour your first gold bar can be anywhere from probably never less than 10 years and sometimes 15 to 20 years from the time you make the initial discovery until you actually start making money. Our thesis here at Nevada Comstock is to short circuit that by dealing with properties that are already largely developed.
That's an important distinction. Howard, tell me about the competitive market. Yep.
We still think we can provide biotech kind of upside, but without the same kind of really long lead time that you'd have to expect in other mining ventures.
Well, you've also got, Howard, and we're going to get into this topic of the economic risks, right? Because you don't know the price of gold and what the market's going to be like years out. Nobody can predict that. But if your timing to monetization is much closer, it's easier to predict what you're going to make out of it when you go into it.
Yeah, I mean, this is always a big risk for mining companies. They start developing a property, and by the time they get ready to go, the price of the commodity that they were chasing has gone through maybe 1 or 2 cycles and is scraping along the bottom.
That's right.
This is another reason that something I learned from a great mining executive by the name of Fred Owsley, may he rest in peace. He was a wonderful operator for ASARCO for years. And I'll never forget, I was having dinner with Fred one night. He ran 3 operating mines for ASARCO back in the 70s and 80s and early 90s, the Core Mine, the Galena Mine, and the Troy Unit up in the Silver Valley. We're sitting around dinner one night, and he said, here's what you got to remember in mining. When the market's bad, you got to keep your costs really, really low so that you can scrape by and make a little bit of money even when the prices are bad. And then when the prices go up, don't let your costs go up at all. Keep them really, really low so you can make piles of money in the good times.
That's right. You got to know how to tighten that belt, right?
Get it tight and keep it tight. That's the key.
I love it. Well, that sounds like a smart operator right there, Howard.
Oh yeah. He was making money. He was making money for ASARCO when silver was $4 an ounce.
Wow. Well, Howard, tell me about the competitive environment. Like who else is out there doing what you're doing, and what are they doing that's different or not as superior?
Well, obviously, we've seen an interesting turn in the market in the last, let's just say, five months or so. The precious metals exploration and development industry has been through about a 7 or 8 year down cycle where very little money was spent developing new projects. The bulk of exploration financing for small companies historically has come out of Canada, been financed out of Toronto or Vancouver, and they tend to chase the latest, hottest idea. A few years ago, with the development of the electric car industry and the lithium batteries, they were all chasing lithium properties all over the world, South America, Chile, Bolivia, Nevada, everywhere they were looking for lithium. They ran up the price of lithium stocks and whatever, and then the lithium boom died out, and next it was cobalt. Everybody had to have a cobalt property. So they staked all the ground over in Lemhi County, Idaho, where the cobalt is in the States, and they went back up to Cobalt, Ontario, and whatever. But reality is almost all the world's cobalt comes out of the Congo, which is a place nobody wants to operate. Can't really deal with the Congo.
Yeah.
So the cobalt boom died out, and just about then, all the Canadians turned to marijuana. And almost all the listings that were going on up in Canada over the last 18 to 24 months were marijuana deals. They raised, I think, $7 billion in the Canadian markets in 2018. and almost all of it was for marijuana deals.
We're we're involved in those. We know a lot about them.
Yeah, I don't. But,
Yeah.
there just wasn't much money being put into the sector
Okay.
for gold and precious metals exploration, and that's all starting to change. But, I think we're starting from a much better place because we have properties that are already developed and all ready for, moving to the next stage, getting a PEA done, a preliminary economic analysis or a feasibility study, and getting ready to finance development of production.
So what you're saying is, I mean, look, it's kind of been out of cycle, right, with other fads that have been chased by the
Oh, it's
marketplace.
been totally
Yeah.
out of cycle for 7 years. Yeah.
Yeah. And then you've had that going on with sort of the economic trends of the pricing pressures in precious metals going down, and that's everything's cyclical, right? So you've got a combination of this sort of coming into economic viability at the same time as look what's happening in the economy, plus the fact that you're not starting from scratch here. It's not a greenfield operation.
Yeah, that's right. I mean, the last time we had a peak in the gold market was in 2011 when it peaked at just over $1,900 briefly, and then retreated all the way back to under 1,100.
Yeah.
It was a long, slow, grinding downturn in the sector, which began to turn around about a year ago.
What is it at now?
$1,785 an ounce.
Where do you put it in a couple of years?
Um, well, I've never been the world's best prognosticator on prices, and as I said, gold doesn't have a price; it has an exchange rate. So,
Right.
if you think the dollar is going to get stronger and stronger as we print more and more of them, if you believe in modern monetary theory, which I actually happen to know you do not believe in, Chris, and neither do I, then that's one thing. But if you believe that creating unlimited quantities of paper money are going to increase the value of it, then maybe there's a bridge I'd like to sell you across the East River out of Manhattan.
That's right. Well, if we get any buyers for that, I'll let you know. Howard, this is really helpful. So, $5 million. What is on the use of proceeds for the $5 million? What are the priorities?
Well, it's kind of split, but about 600,000 or 700,000 of it will go to capitalize working capital on moving those dumps and turning them into money.
Makes sense.
In this first batch of money, we'll get back underground and we'll drill test the downward extension of those veins, put some proof to what we believe we know. We'll get up to that saddle deposit where Glenn's Inn outlined that 5 million ounce target, and we'll do some sampling and some initial drilling and try to put some reality to that. And then over at the Gray Eagle, we'll immediately get after some drilling on that oxide gold zone, because there could easily be 100,000 ounces of readily accessible gold on the side of that hill. And then we'll do a reevaluate. We'll get back underground on the copper deposit, and we'll do a preliminary economic analysis and review the old Pincock, Allen, and Holt data. And then I think we're going to do some drilling to drill the downward extension of that deposit. We think we can probably double the tonnage with a few holes. So there's a lot we can do with this first 5 million, an awful lot.
That's good to hear. Yeah. What do you got, Howard, for after this? How long do you think it's going to take to monetize? You were talking a matter of months, half a year?
I think within a year, we should be in a position to have a lot of really hard data in terms of, I guess, what I'd call 43101 compliant resource.
Yeah.
We'll have demonstrated the ability to monetize those dumps, and we'll have a very solid resource base at both the Gray Eagle and the Lexington. And at that point, we should be in a position to do an initial public offering.
Okay. Howard, there's a saying called gold bugs. Gold bugs, that's what they call the investors that just love that industry. How do you make a case to people who aren't used to investing in this field, which can seem a little bit esoteric or special, right? Not without the specialized knowledge. Why not just go buy gold, right? Why a mining company with patented claims?
Well, first of all, as somebody who doesn't believe in modern monetary theory and believes more in Austrian economics vis-a-vis Hayek and Mises, I'd say everybody should own some physical gold. Nothing wrong with that. I think it's a good key part of anyone's portfolio, particularly right now.
Yeah.
I also think physical silver has a real place in a person's portfolio because I think the silver move has lagged gold up to now because I think a lot of the smart money, institutional money, has moved into gold, but I think the retail investor has been a little slower to jump on the bandwagon, and when they do, I expect silver to make a very dramatic move, the $18 range where it is now, and it should at least touch where it hit in the last cycle, closer to $50. So there's a lot of room for silver to move, and silver will have an important place as it regains some monetary features.
Yeah.
It'll begin to feature in the monetary world again. Right now, it's pretty much trading as an industrial metal. And it's a beautiful industrial metal with many, many, many valuable applications.
It
But
sure
it's
does. Yeah.
but it's going to regain some monetary value as well. So let me start by saying I think everybody should own some physical gold and physical silver, but there's obviously more leverage in a mining project. So for instance, if we were to successfully able to outline a resource of, let's say, 1,000,000 ounces of gold, right now, 1,000,000 ounces of gold in the ground, I'll just do a little math here. I mean, 1,000,000 ounces of gold, measured indicated gold resources right now with gold at $1,785 an ounce are commanding a value of about $120 an ounce in the ground as a resource. So 1,000,000 ounces of gold, gives you a very substantial value of $120 million as a value of your project. Mm-hmm. Well, we're going out here with a $12 million post money valuation. So if we were to outline 1,000,000 ounces of gold, you would expect we could go public with a valuation of 120 million.
Right. That's right.
So it's it's biotech kinds of returns, but and with a shorter time span. So that's the kind of leverage you can get in a mining project.
So the hope is to sort of take advantage of the market, a good opportunity, but also market dynamics we're dealing with now, which could magnify the outcomes, right?
Without a doubt.
Yeah.
Without a doubt. I mean, look, our costs are not going to change much from what we project them to be now. I mean, obviously, as the inflation genie is out of the bottle, and there will be cost increases over the next few years, but they will not be as dramatic as the rise we would expect in the price of precious metals.
Howard, there's trillions in liquidity sitting on the sidelines. You were saying the smart money's already, so much of it's already in gold. I'm not surprised. If the market, is that going to get back into the market? Is that going to inflate the price of gold? Is it going to come out of gold and back into the market? I mean, we're hitting new highs right now, which is something we'll hit when you start getting real. Because you gotta keep up with them here, buddy. I think I'm already a half bottle in.
I'm halfway through my
Oh, there we go.
But what I was going to say, Chris, is I'm quoting another analyst who said, there's such a small percentage of the investable capital that's in precious metals right now. I mean, if you look at the big funds, most of them have no exposure to gold. If they try to get into the gold market in a big way, as one guy said, it'll be like trying to cram the Hoover Dam through a garden hose. So, the potential for an explosive rise in the gold and silver price is out there. So right now, I think what we're seeing with all the money creation that's gone on, and it's gone on in a very big way since coronavirus hit us back in March, you're seeing a lot of that money is chased into the market and has created some very strange things. I mean, Tesla today was up $169 a share.
Yep.
$1,879 a share. It's now valued at $254 billion. So Tesla is trading at 10 times the market cap of the Ford Motor Company, 8 times the market cap of General Motors, and 1.5 times the market cap of Toyota, and 1.5 times the market cap of Exxon. Now, I don't have anything against Elon Musk and Tesla, but that's ridiculous.
Well, I own a Tesla, and that's ridiculous. So I get it.
Yes, exactly. I mean,
Well,
it's one thing to own the car, fine.
Look,
Market cap 200.
Elon even said his stock was too high, and they still didn't help. Did you catch that when he said that?
I did not see that.
It pissed off his board. He came out and said, my stock is too high. The stock went down for like a few days, and then it was back up. I love it.
I saw where Wedbush came out with a $2,000 price target.
Wow. I love it.
I don't know.
We're living in special times, Howard.
I just scratched my head because, I mean, obviously, I wonder how much institutional money is going to want to pour into Tesla at $1,400 a share.
Yeah. I love it. Well, let me tell you this. You've been, it looks like it's time for us to talk about the markets a bit, but before that, you've been working with us for several months now, getting ready for your round. You're working with some smart people on the team. What's been your experience so far?
Oh, with Exemplar, yeah.
Yeah.
I mean, our experience has been 100% positive. I think the guys on your team have been very helpful. I think we've put together an outstanding presentation, and they've helped us to refine it, perfect it, make it more understandable maybe to the layman investor that's not steeped in gold mining, silver mining, or base metal mining. So we're very excited about working with you guys. And, we want to go out and get this raise done and get busy.
That's right.
That's right. Value for shareholders.
That's what it's about, Howard. That's it. The end of the day. Well, look, prior preparation prevents poor performance. That way we've learned. And look, it's important at this time in the markets that this type of opportunity not just be accessible to the gold bugs, because this is a really special time to be in this kind of a company. So it's been
I
great.
think if I were to look at the sectors that I would like to be invested in right now, it would be perhaps invested in companies that might have an answer to the coronavirus, a treatment for it that would be successful, or I'd want to be in gold mining because the value of gold vis-a-vis the U.S. dollar is about to experience a rather breathtaking awakening.
I think that's our cue to go into the next section and start getting real.
Okay.
All right. Well, this is the next section of our show, CEOs Get Real. It's time for us to just talk about whatever comes to mind, which is beautiful. It could be anything from politics to economics. But Howard, one of the most pleasurable times I had with you, this is rare because I'm incredibly a high-touch person, and this COVID thing has been very strange because I'm used to shaking hands and meeting face-to-face, and we finally had a chance to do that in one of the only lobbies in Santa Monica that was open, sitting socially distanced, 10 feet apart, right outside of a bank. And we did this, and what we had discovered was we both have a love for economics, particularly Austrian School of Economics, which is amazing. Hayek, Gilder,
Von Mises.
Yes.
I have to tell you, if we're just getting real, I have to tell you a story. One of my favorite people in this world was a colleague of mine from Australia by the name of Ron Kitching. Ron owned the largest contract exploration drilling company in Australia. He died a few years ago in his 80s, but he was a wonderful man, and he was a member of the Mont Pelerin Society of Austrian Economists. And in 1990, he was invited to go to Moscow University in Russia and give a week-long seminar on Austrian economics to the PhD students in the Moscow School of Economics, where these PhD students had never been exposed to anything except Marx.
Marxism, yeah.
Yes, that's all they'd been taught their whole life was Marxism. And here he comes in with von Mises and Hayek and Austrian School Economics. And they were all, fascinated by what he had to say. And on his way home to Australia, he stopped off in the United States. I met him in Atlanta, and he wanted to go visit the von Mises Institute and meet Lou Rockwell and Auburn University. So I picked him up in Atlanta, and we drove down there and spent half a day at the von Mises Institute. And then we drove back to Atlanta. And on the way back, we were hungry, and we pulled off the freeway, and we went in and had dinner at a Denny's restaurant.
Denny's?
Denny's. We're all familiar. Well, it was right off the freeway, right? We're hungry. So we go into Denny's, and we had dinner. And, of course, Ron was fascinated by the laminated Denny's menu that they have with pictures of all the food, right? So he asked the manager, he says, right, Mike, do you think I might be able to have one of these menus? I'd like to send it over to some students that I had over in Russia. I think they might be quite fascinated by it, right? So the manager gave him this menu, and he mailed it off to Russia. Well, he called me a few weeks later, and he said, you're not going to believe the chaos that menu caused. I said, what do you mean? He said, well, apparently they argued about this menu all week in the PhD School of Economics. First of all, they thought this has to be
fake news,
propaganda. There's no possible way that a restaurant could be there to serve a turkey dinner 7 days a week, 24 hours a day. You could get bacon and eggs any time of the day or night, 24. This is impossible. This has to be Western propaganda. And then they finally got around to the point that, well, if such a place did exist, this would only be for the upper 1% of society. And Ron had to explain to them that the high end of American society would never be caught dead in Denny's. This is for the working guy. They simply could not grasp how Adam Smith's invisible hand could function.
That's
to provide
right.
Unlimited bounty to the average consumer.
Howard, that's a great story. And for all the viewers who didn't strike A's in economics or just don't understand it, Karl Marx's labor theory, which sadly we've been stuck in for way too long, because modern economic theory, subjective theory of value, Austrian School of Economics, has long been known to be the most superior in the world, but we've been stuck in this Karl Marx's labor theory, which falsely assumes that there's a linear relationship between the time it takes to do a thing and the value. Now, that was disputed and proven false early before it was implemented, because if it were true, then the piece of coal, this is a mining analogy, by the way, the piece of coal would have the same value as the diamond sitting on the ground right next to it that you mined, just because it took you the same time to go get it. But everybody knows that's not true. Because people value the diamond different than the coal. You find a lot of junk under there after spending millions of dollars drilling. There's a lot of stuff you don't want. And
sure.
Yeah.
Lots of waste.
Right? So, it's amazing how common sense, how easily you could refute an economic theory that managed to stick with society so long, right?
Well, the one that gets me now that's being floated out there, I mean, it was a big part of the Bernie Sanders campaign, was this so-called modern monetary theory, MMT, which is, in my mind, the most ridiculous thing I've ever heard. I mean,
I thought it meant modern magical thinking.
Modern magical thinking, yeah. I mean, it's like, well, government doesn't have to worry about taxation or anything. They just print the money. They
own the printers, right, Howard?
Yeah, the sovereign entity, they can just create unlimited amounts of money to pay for everything. We don't have to worry about taxing people or slowing down federal spending or government spending, because we're sovereign. We can just print it, right?
That's crazy stuff. It's crazy talk. It's crazy talk.
Somehow I don't think Hayek or von Mises would think much of that theory.
Right. Well, so doesn't it remind us that we're at a time in history, Howard, where we're talking about erasing it with statues and all this crazy town stuff we're talking about, and you and I are talking about stuff that people haven't even awoken to, right? Which is there's just this beginning of an awareness about value theory, and what Marxism is, and labor theory was, and isn't it amazing that people haven't woken up to this?
Yeah, I've just been rereading a book I read some years ago called When Money Dies. And it's the story of the Weimar hyperinflation in Germany in 1923. But I think the key point to me is most people don't realize how fast it can happen. Most people think, well, if inflation started to ramp up a little bit, we'd have a chance to figure it out and we could bring it back under control. Basically like Volcker did in the early 1980s by raising interest rates to 20% and wringing the neck of inflation. That's no longer possible.
So tell me about that, right? I mean, I'm a Generation Xer, right? So I was young at that time, but I remember something referred to as Reaganomics, right? Didn't Reagan inherit some of wasn't the Reagan time period some of the biggest time period of inflation that we've known?
What happened was, we had the great inflation of the 1970s. Which, we at one point the inflation rate had touched 16 or 17% in the Carter years. And shortly before he left our office, Carter appointed Paul Volcker as chairman of the Federal Reserve. And Volcker embarked upon a policy of rapidly increasing interest rates to choke off inflation. And of course, what that did was to trigger the recession of 1981 and the deep recession of 1982. Right. And Reagan, to his credit, having taken office in the beginning of a economic downturn,
right,
did not put any pressure on Volcker to back off his policies. He realized that we had to wring the neck of inflation, and so I think by the midterm elections in 1982, Reagan's approval rating was all the way down at like 26%. Because we had a really serious recession in 1982. But it worked. The inflation rate was capped and dropped back down into the low single digits. The employment took off in 1983, and Reagan was reelected in a 49-state landslide in 84. But what Volcker did back then is no longer possible, because when you have a $26 trillion national debt, if they let the interest rates go to 10%,
we're screwed.
Interest on the debt would consume 100% of tax revenues.
That's right.
They have to keep the interest rates close to zero. They can't raise them because they have no room to do that. That arrow is gone from their quiver forever.
Howard, isn't it remarkable how few people understand this?
It really is. If you go back to if you look at the history of the Federal Reserve, the last time we really had a Federal Reserve chairman and a president at the same time that were committed to maintaining the purchasing power of the dollar was the early 1960s, when William McChesney Martin was chairman of the Fed and John F. Kennedy was president. Kennedy believed strongly that you needed to approach the federal budget as something that needed to stay in balance. And William McChesney Martin's famous saying was his job was to take away the punch bowl just the minute the party started getting going good. So as not to let the economy get overheated with hot money. Yeah. And of course, we were still on the gold and silver standard during the Kennedy administration. It was 1964 that Lyndon Johnson stripped the silver out of the coinage and embarked on the Great Society spending profligacy of guns and butter, the Great Society at home and the Vietnam War abroad, which ultimately led Nixon to have to close the international gold window in 1971. And then the gold price exploded.
Well, now you have the government is because of the stimulus becoming a market participant. Right, because they're heavily. Well, that's another dynamic we have to deal with, which is pretty significant, isn't it?
Well, I mean, I think that some of the things that we're seeing in the market right now that make no sense. It's obvious because that's where some of the hot money that's out there has flowed. It's flowed into equities. It's flowed into the bond market. It's flowed into the debt markets. But you know, the orgy of debt that's going on at the federal level, at the state level. I mean, some of the states, including the one that you're sitting in and that I live in part of the time, it's it's an insane number that cannot be managed.
So there was a time, it sounds like you were saying there was a time in our history, because it was before my time, that balancing a budget wasn't considered fiscal conservatism. It was simply called being rational.
Sanity. It was called sanity.
That's right.
You know, we went into the early 1950s with an enormous federal debt as a result of World War II, but we paid it down during the Eisenhower and Kennedy years.
Wow. So this is an interesting time because we, like I said, I can't think of other arrows in the quiver to solve the inflation problem if it comes back. And there was a saying, Howard, that democracies are prone to spending themselves out of existence because of the very reasons we're talking about now. Absolutely, government spending and handouts and people voting themselves handouts that essentially spend itself out of existence.
Yeah, I mean, it's there's never been a time in history over the last 5,000 years that I'm aware of where every government on earth was participating in a race to the bottom. Who can devalue their currency the fastest? They're all fiat currencies. None of them have any reality, and it's a race to the bottom. And apropos of what you just said, Chris. One of my favorite sayings of President Reagan back when he was in office, he said, when you rob Peter to pay Paul, you can absolutely count on the vote of Paul.
That's right. Well, that's happening all over the place, isn't it?
Absolutely.
Forgiven college debt, UBI, benefits for immigrants that are undocumented, right?
Yeah, of course.
Yeah.
It's bread and circuses all over again. The Romans tried this in 400 AD. It didn't work out too well for them either.
Do you think people don't realize that history repeats itself? Is it or should we just erase history and therefore we don't have to know? We'll just repeat it.
Well, it's been said that those who do not understand their history are condemned to repeat it. I forget who it was that said this, but he said, history doesn't exactly repeat, but it rhymes. And people have been here before where they think they can get something for nothing. I like to look at the history of what stable money can do, and a point I like to make, Chris, is that if you think back over the last 20 years, really, I mean, Powell and before that Yellen and before that Bernanke and before that Greenspan, they've all told us that the Federal Reserve is targeting 2% inflation, right?
Yeah.
They were targeting 2% inflation. So what they're saying is, we're planning to steal 2% of your money every year through inflation.
That's true.
Now, you and I, we may be a little better off financially than the average working guy, or heaven forbid, the single mom working as a waitress at a diner. We can probably absorb that inflation tax better than the person at the lower end of the socioeconomic ladder for whom taking away 2% of their money is kind of a big deal. And that's if you actually believe that we only have 2% price inflation, which I think we both know is not true. But I like to look at the history of the United Kingdom, of Britain, from 1750 to the outbreak of the Great War, because they had, for over 150 years, a virtuous cycle of stable money, which was backed 100% by gold, and at the same time, they had ever-increasing productivity as, technology advanced in the Industrial Revolution and some of the things in the late 18th century. So productivity was climbing, but the money was stable. So the money was level, productivity was climbing. So for 150 years, they had gently falling prices across society that made everybody better off. Even the poorest working guy, his money bought more every year because prices were falling, productivity was gaining, the money was backed by gold, and everybody in Britain was getting more and more well off until they fell into an orgy of debt to finance World War One.
Well, it sounds like Howard. Well, there's a number of directions we could take with this. I was going to ask you about China, because China's been buying up the world's gold. If you didn't know, most people aren't paying any attention to it because they're sneaky, and they probably want to overtake the United States as far as the reserve currency. And I wouldn't be surprised if they got a plan to back it by gold. What is your opinion on that, if you've got one?
I have exactly the same opinion. I think, China tends to play a long game. They tend to think in terms of decades or centuries rather than quarter by quarter earnings statements. They've been touting themselves as the world's largest gold producer for the last 10 years. Every ounce of gold that's produced in China is sold to their central bank by law.
Yep.
And they've been in the open market buying gold with some of the flood of dollars that they've taken in. So I think it's very much a part of their long-term plan. I don't have any specific knowledge of that, but I got to believe that the Chinese have probably studied history and realized that if they want to become the dominant world power of the 21st century, they can do it without firing a shot. All they got to do is have the yuan take over from the U.S. dollar as the reserve currency.
That's right.
That may not be that far off.
So if you take a combination of the fact, Howard, that we're printing money like crazy, which there has to be a point at which inflation picks up. We're not talking about billions. We're talking about trillions. We're talking about trillions that double in terms of deficit every 4 years, perhaps.
Well, we were looking at, in February of this year, the government was projecting a deficit for fiscal 2020 ending in September of about $1 trillion. Now, with the stimulus money and everything that's happened, on the spending side, they're now projecting that we're going to go from 4.7 trillion to over 7 trillion in spending. But the tax revenues that were projected to come in at 3.5 trillion are going to collapse to maybe 2.5 trillion. So we're looking at a $5 trillion deficit for the fiscal year ending in September. That's an unimaginable number.
Right. And I think we're looking at a generation, Howard, of people in the millennials and even Xers who haven't seen inflation as a consequence of deficits and spending. And so you've got that in a combination with the fact that inflation inherently hurts the lower tier of society more. But then you've got also this pandemic, which has destroyed Main Street, right? Because technology people and executives and the highly educated have great jobs. Amazon's at highs, Tesla, but our restaurants are closed. The local stores are closed. People that are retail workers. So, then you got the whole wealth gap issue, which has been a problem right from the beginning. And look at the studies throughout history of wealth gaps and what that causes to markets. And we're at the highest we've ever seen.
Yeah, I mean, I think that the impact of the coronavirus shutdown was in the top of the second inning. I mean, the economic downturn. I mean, look at what happened with Hertz. I mean, 19 billion in debt. They filed for bankruptcy. It's clear that the equity holders at Hertz are going to come away with 0.0 for their shares, and yet the market bid up the shares to $5.
I don't get it.
You've ever seen.
I just don't get it.
No, I mean, because those equity holders are going to get zero.
Uh-huh.
But it's just I don't know. I just want to. If I had any hair, I'd tear it out, but I don't. So.
Well, I was thinking about giving my degrees back, asking for a refund, and buying some puts.
Yeah, really. It's a strange time that we're in because, there's whole industries that are never going to be the same.
That's absolutely right.
Airline industry is never going to be the same. I mean, I just don't see people jumping back on airplanes to the degree they were in February.
Yeah.
And some of the big airlines are going to be in real big trouble. I mean,
I travel 50% of my life, right? That's been my percentage, 30 to 50%. And I can't do that with this going on and a mother-in-law and two young kids. It's just not going to happen, right? I certainly can't be the only one. That's that. If my travel's 50% impacted, that's going to destroy. There's a lot of companies going to go bankrupt, and then there's another problem with that: is where do the trillions come to bail out the industries?
Well, what about the rental car industry? They're dead.
Yep.
Hotel industry, we've got hotels that are way overbuilt for the amount of traveling that's going to be going on now, with the airlines in trouble.
Mm-hmm.
You know, there will be spots that'll be okay. You know, like I'm thinking, from here in Spokane, I think people rather than jumping on a plane and flying to Disneyland, they may drive up to the lakes, North Idaho, for summer vacation, but they're going to think twice about the long travel to Hawaii or whatever. Who knows? I think Las Vegas is in huge trouble right now. I think commercial real estate's in huge trouble.
Huge trouble.
Huge trouble. I mean,
yeah.
Look, I mean, let's just talk about what I've gone through as the CEO of Nevada Comstock with my investment bankers at Exemplar Capital. We've done all this by Zoom.
Yeah.
I've been on with your guys in New York and New Jersey by Zoom. John's been on the call from New Jersey where he's at. I've been out here in California or Washington State. Andrew's been in New York City. Federico's been in New Jersey, and we all get on a Zoom call, and it's just like we're in the same room. And I didn't have to jump on a plane, fly across the country, buy an airplane ticket, spend $500 a night in a New York hotel, try to squeeze into one of those little bitty New York taxis. Didn't have to do any of that. We got it all done, and we're here. We're ready to go.
Well, that's true. I think it was somebody who, I think it was Kevin O'Leary who was saying, nobody would have ever thought to try a sick experiment of sending everyone home to see if commerce could actually continue at any clip that's reasonable remotely. But the pandemic forced it, and what's happening is people have figured out how to adapt. And that has to change the face of the marketplace for permanently, right?
I think so.
Yeah.
I think it's there will be winners, of course. Anytime there's a big adjustment, there's going to be winners. But there's also going to be losers. I mean, there's going to be buggy whip manufacturers that get whipped right out of business here, like the buggy whip manufacturers did in 1900.
That's right.
That's right.
Well, look, any transformation is an opportunity for new growth.
That's right. I mean, just in my lifetime and even in your business career, back when you started, there were travel agencies that did bookings.
Oh God.
When's the last time you saw a travel agency?
Never.
Right, they're gone.
That's right.
Wiped off the face of the earth.
Yeah. Well, Howard, look, now you picked a great word to end this thing on, which is winners. We're at a good market for what Nevada Comstock is doing. You guys are an amazing team. It's been amazing working with you both. You're smart. I think everybody can tell from this show. You got a lot going on up there. But you'd have been in this space a long time. The market conditions, the patented mining claims and what that gives you as an advantage relative to peers. Just what's going on with the pandemic and printing money and just the economics generally. You're poised to be a winner. That's our bet, and we're right behind you.
Well, thanks, Chris. It's been fun to be on your show, and even though it was remotely, we had a good time. And thanks again, and I'm almost out of gin and tonic, so we must be done.
Well, let's do a toast real quick. Really great to be with you. Thanks for coming on the show, Howard.
Thanks, Chris.
All right.
Talk to you soon.
You got it, everybody. Thanks for joining CEOs Get Real. We had a great time with Howard Crosby from Nevada Comstock. Thanks for joining us. Have a great night.